What if I told you that the smartest person in the room is actually usually the one losing the most money?
I mean, it goes against everything we're taught, right?
Totally. Because if you picture the ultimate market winner for a second, if you watch literally any movie about Wall Street, you probably imagine this absolute genius.
Oh, yeah, sitting in front of a curved wall of like 6 glowing monitors.
Exactly. And they are just frantically parsing through these complex algorithms, absorbing global data feeds at lightning speed, you know, outsmarting the crowd by reacting before anyone else even blinks.
It is an entirely intoxicating image. I mean, it really is. And from a macro structural perspective, it is largely a myth.
Right.
Because intelligence and financial markets, it's glamorous and it is incredibly loud. But when you step back and actually view the market as a massive operating machine,
Which is what we're doing today.
exactly, you realize very quickly that markets do not consistently reward raw brilliance. They just don't. They reward patience, survival, and emotional control.
Welcome to today's deep dive, everyone, because our mission today is to explore this deeply counterintuitive reality.
It's a fun one.
It is, because we want to know, why is it that in an environment ruled by extreme uncertainty, these massive cycles, volatile timing, why is knowing exactly how to wait infinitely more valuable than, thinking fast?
It is a really difficult reality for highly educated, highly motivated people to accept because patience is quiet.
Yeah, to the untrained eye, it often just looks like hesitation or even laziness.
Right. But the actual mechanics of the market heavily punish constant action, and they absolutely reward deliberate inaction.
Okay, let's look at the friction there. Because if you possess incredibly sophisticated knowledge, say you have a wall of degrees behind your desk, right?
Sure.
And you understand the absolute minutia of global supply chains or like monetary policy better than anyone else, shouldn't you naturally be able to forecast moves better?
You would think so.
Yeah. So why does being the smartest person actually cost you money in this scenario?
Well, we have to look at how we are conditioned to view success from like a very early age.
You mean school?
Yeah, since childhood, we are basically taught to view life as an academic exam. In school, the person with the highest intellectual ability who studies the hardest and remembers the most facts gets the highest score.
Right. It's a direct linear correlation.
Yeah.
More effort and more intelligence equal a better outcome.
Exactly. And people bring that exact same framework into financial markets, but the market is not an academic exam.
It's a completely different beast.
It is a highly complex system of probability, mass psychology, and liquidity shifts. Knowing more facts simply does not guarantee a higher return.
Because knowing the facts doesn't mean you control the outcome. It just makes you feel like you should be doing something.
Ding ding.
I'm picturing like a brilliant farmer. They know the exact chemical composition of the soil, and they understand the biology of a seed perfectly.
Right, they have all the data.
But instead of planting the seed and just letting the seasons do the work, they go out into the fields every single day and pull on the stem to try and make it grow faster.
And they just end up uprooting the crop.
Exactly. They destroy it.
Their intense desire to intervene, which is totally fueled by their deep knowledge, actually destroys their yield.
Wow. Yeah.
In financial markets, high intelligence often breeds this overwhelming need to constantly intervene. We call this the illusion of control.
The illusion of control, meaning they think they can manage the chaos.
Yeah. The more knowledge a participant possesses, the more they feel capable of forecasting every single micro movement.
So they see a headline, and their smart brain instantly builds this complex narrative around why that specific headline matters.
And they convince themselves they have to act on it immediately. Every headline is a mandate to trade.
So they are just constantly adjusting, constantly trading based on noise.
And bleeding their capital dry on 1,000 tiny, completely insignificant moves. The market severely punishes that exact type of unnecessary activity.
It's death by 1,000 cuts.
Exactly. Smart traders frequently become trapped in endless analysis, which leads to massive overconfidence, excessive trading, and ultimately severe emotional exhaustion.
They lose money simply because they couldn't resist the urge to prove how smart they were on a daily basis.
Yeah, it's an ego trap.
But, I mean, if over-tinkering is the trap, doing absolutely nothing feels like a failure. We are hardwired for action as humans.
We really are.
If you have a problem at your job, you work harder to fix it. If your car breaks down, you get under the hood and tinker with it. Action literally feels like progress.
Right.
So Sitting in front of a market and just watching it goes against every evolutionary instinct we have.
Think about the last time you watched your portfolio just go completely sideways for a month. It's agonizing.
That's the worst. You just want something to happen.
You feel this desperate compulsion to click a button to make a trade just to feel productive. That intense psychological friction really comes down to two primary destroyers, boredom and FOMO, the fear of missing out.
Because many people lose massive amounts of capital simply because they cannot tolerate a flat, quiet market.
Exactly. They confuse movement with progress, so they artificially create action by forcing mediocre trades.
And then there is the pain of watching a move happen without you.
Oh, that's even worse. Watching a chart go up and knowing you aren't participating in it causes literal, measurable emotional pain.
You see everyone else appearing to profit on Twitter or wherever.
And that pain pushes you into terrible decisions. You enter a trade way too late, or you size your position far too aggressively to make up for lost time.
Right. You abandon your entire analytical framework just to relieve the social pressure of missing out.
Yep. You trade your discipline for emotional relief.
And I feel like the financial media complex seems practically designed to trigger that exact emotional pain.
Oh, 100%.
Everything is presented as daily entertainment. Every slight movement is a breaking news alert.
Right. It's always framed as this urgent opportunity that you have to act on right this very second.
They turn a strategic long-term environment into a daily casino, which makes waiting even harder.
They absolutely do.
I do want to push back on this a little bit, though.
Go for it.
Because doing nothing, especially when your own money is on the line, can easily cross the line into negligence.
Sure.
How do you actually distinguish between strategic waiting, where you are doing the right thing, and just being paralyzed or too scared to pull the trigger?
That is the million-dollar question. The distinction lies in the concept of an edge.
Okay, explain that.
Patience is not refusing to act. It is refusing to act without a clear, probabilistic edge.
Ah, okay.
When you are paralyzed, you are frozen by fear, right? You're unable to execute even when your strategy dictates that you should.
You have the green light, but you just freeze.
Exactly. Strategic patience, however, means you are highly alert and actively observing, but you're deliberately choosing to preserve your capital because the conditions are unclear.
So you are basically just preserving your ammunition.
Exactly. You avoid a mediocre opportunity to preserve your financial capital. But honestly, perhaps more importantly, you preserve your psychological capital.
Because you aren't exhausted from fighting the chop all week.
Precisely. So when a truly exceptional asymmetric opportunity finally appears, you have the absolute clarity and the firepower to deploy aggressively.
Okay, you just mentioned an asymmetric opportunity. Just to ensure we are completely clear for everyone, we are talking about a setup where you are risking a little to potentially make a lot, correct?
That is the textbook definition, yes.
Like the kind of skewed risk-reward ratio that can genuinely make a career.
A scenario where your downside is strictly defined and limited, but your upside is massive. But here's a catch. Those setups do not happen every day.
Right, which brings us to the actual physical mechanics of the market.
Let's get into it.
We know why the psychology of waiting is so difficult. But if we look under the hood of the market itself, what are the structural mechanics actually forcing us to wait for these asymmetric opportunities?
We have to look at market structure through the lens of Wyckoff principles.
Richard Wyckoff.
Yes. He was a pioneer in analyzing the actual footprints of large institutions. And his core insight was that markets do not move in isolated daily events.
They don't just randomly spike up and down.
They operate through massive, incredibly slow campaigns. The market moves through a continuous cycle of 4 distinct phases: accumulation, expansion, distribution, and decline.
Okay, let's break those down. Why do these phases require so much time to play out?
Because of institutional positioning. The large operators, the sovereign wealth funds, the massive asset managers, they deal in enormous size.
They're moving billions.
Exactly. They cannot simply click a button on their phone and buy $1 billion worth of an asset all at once.
Right, because if they did, they would instantly drive the price up against themselves and ruin their own entry point.
Exactly. Slippage would destroy them. So they have to build their position very slowly and very quietly over time. This is the accumulation phase.
So what does that actually look like on a chart for a regular trader?
It looks incredibly boring.
Just sideways.
Yeah, it is a long, flat, choppy, sideways trading range. The institution is basically using algorithms to buy small batches of the asset over weeks or even months.
absorbing any selling pressure, but never letting the price actually break out.
Exactly. It is intentionally designed to be frustrating for retail traders.
So wait, when an impatient trader gets bored of that flat chop and they force a trade, but the market goes nowhere, so they sell out of frustration, what are they actually doing?
That is the brutal reality of the mechanism right there. When that impatient trader forces a trade and then just gives up, they aren't just making a mistake in a vacuum.
They're actively funding the institution's entry.
Yes. The impatient trader gets frustrated and sells at the market price, and the large institution is sitting right there, quietly buying those exact shares.
So the impatient retail trader is literally providing the liquidity for the institutional campaign.
They are the fuel for someone else's strategy.
Man, that is wild. So what happens when the institution is finally done accumulating?
Then we enter the expansion phase, which is often called the markup.
Okay.
The institution stops absorbing supply, and they might even push the price over a key resistance level on purpose.
And suddenly the price breaks out rapidly.
Yes. And this is when the broader crowd, the impatient traders who miss the bottom because they got bored, finally notice the trend.
Their FOMO kicks in hard,
Exactly, and they rush in to buy, which violently drives the price even higher.
which sets up the third phase.
Yes, the distribution phase.
The opposite of accumulation.
Exactly. Now, the institution has a massive, highly profitable position, and they need to sell it to lock in gains. But again, if they dump it all at once,
They crash the market.
right. So how do they exit? They sell their shares directly into the intense buying pressure of the FOMO crowd.
Wow. So the impatient trader provides the liquidity at the bottom by selling out of boredom, and then provides the liquidity at the top by buying out of greed.
It is a devastating cycle if you do not understand it. And once the smart money has completely distributed their holdings to the latecomers, the support is just gone.
And that triggers the final phase.
The decline. The price collapses, the late buyers are trapped with massive losses, and the cycle eventually resets back into a new accumulation phase at the very bottom.
This cycle makes perfect logical sense when you spell it out, but living through it seems incredibly difficult. I want to see how these mechanics map onto actual historical events.
Sure.
Think about the late 1990s.
Oh, the dot-com bubble is a textbook example of a massive distribution phase.
You had all these countless highly intelligent investors who looked at the fundamentals.
Right, they looked at companies with literal zero revenue, trading for billions of dollars, and they knew it was entirely detached from reality.
But knowing the facts didn't save them.
Because the expansion phase was so violent, the euphoria just completely overwhelmed their discipline.
They watched their neighbors making absolute fortunes on worthless internet stocks.
And the social pressure was just unbearable. Many of the smartest people in the room ultimately abandoned their valuation frameworks, jumped in at the absolute top of the market.
The distribution phase.
Yep. And they were subsequently destroyed during the decline.
And what about the patient operators? What were they doing?
They endured the pain of looking foolish for years.
Which is really hard to do.
It's incredibly hard. But they preserved their capital, they waited for the decline phase to completely exhaust itself, and then they stepped in during the subsequent accumulation phase.
To buy exceptional surviving companies for pennies on the dollar.
Exactly.
That pain of looking foolish seems like the ultimate filter. Because if we look at, say, the 2008 financial crisis, we saw a very similar dynamic, didn't we?
Very similar.
From roughly 2005 to 2007. Anyone raising a red flag about the housing market or the banking system just looked like a complete idiot.
The market was heavily rewarding the most reckless risk-taking imaginable.
So how does a trader maintain their sanity when they know the structure is rotting, but the price just keeps going up?
It requires a deep understanding that the financial system can remain irrational far longer than you can remain solvent.
The old Keynes quote.
Exactly. In 2008, the intelligent observers were absolutely right about the toxic mortgage-backed securities.
They had the thesis nailed.
But timing is rarely immediate. If you shorted the housing market too early, you bled capital every single month, paying premiums while waiting for the crash.
Right, so if you ran out of capital or emotional endurance before the structural shift actually happened, your intelligence was utterly useless.
You could be 100% correct on the thesis, but if your timing is off, you still go bankrupt.
Wow.
Survival and longevity are the actual edge. The smart move wasn't just identifying the housing bubble, it was pacing your exposure so you still had ammunition when the liquidity conditions finally broke in 2008.
That makes a lot of sense. And we saw a hyper-accelerated version of this exact mechanism during the 2020 pandemic panic, didn't we?
We really did. Extreme fear created a massive, highly compressed accumulation opportunity.
The market was basically in free fall.
The VIX was spiking to historic levels, and you had forced liquidations everywhere. People were getting margin calls and selling, not because they wanted to, but because they absolutely had to.
Which means they were providing ultimate liquidity.
Exactly. And the participants who generated generational wealth during that specific period were not the ones frantically trying to day trade the volatility on the way down.
Right.
The massive wealth was captured by the patient operators who had just preserved their cash over the previous years.
They just waited for the crash.
They simply remained calm, stepped in at the absolute maximum point of fear when correlations went to 1, and acted as the buyer of last resort.
Okay, you mentioned correlations going to 1. Let's dig into that for a second, because that is a crucial piece of the macro puzzle.
It really is.
When we face major global shifts today, things like currency instability, commodity supercycle, geopolitical realignments, how does the math of longevity actually protect you during these massive regime changes?
Well, during a major liquidity crisis or a severe regime shift, asset correlations tend to go to 1.
Meaning everything crashes together.
Everything. The terrible assets and the fundamentally incredible assets all get sold off indiscriminately because participants just desperately need cash.
The baby gets thrown out with the bathwater?
Precisely. Now, look at the actual mathematics of loss. If you lose 10% of your portfolio, you need an 11% gain to get back to even.
That's manageable.
Very manageable. But if you lose 50% of your capital because you were fully invested and completely impatient during a choppy, declining market.
You don't just need a 50% gain to recover.
No, you need a 100% gain just to get back to 0.
Wow.
And a 90% loss. That requires a 900% gain.
Which is almost impossible to achieve quickly.
It takes years, sometimes decades. This is why preserving capital during hostile conditions creates the ultimate asymmetric advantage.
Right, because if you have avoided that 50% drawdown and you are sitting on cash when those correlations go to 1,
cash becomes your absolute greatest weapon. You are the only one with liquidity when generational assets are suddenly priced at a massive discount.
while everyone else is just paralyzed or being forced to sell.
Exactly.
So it isn't just about avoiding the pain of the drawdown. It is about what that preserved capital actually allows you to do at the absolute bottom of the cycle.
Yes,
But earlier you mentioned preserving psychological capital too.
very important.
Because if you manage to save your money, but you've spent 3 years constantly stressing over screens, forcing mediocre trades, and taking tiny losses, you still might fail, right?
You will almost certainly fail. Emotional preservation is just as vital as capital preservation.
Because you're burnt out.
Yeah,
Yeah.
if you exhaust yourself through constant, unnecessary activity, you gradually destroy your own confidence.
So by the time that generational opportunity actually arrives,
You will be way too fatigued and too gun-shy to actually execute the trade. You'll freeze.
man. So the participant who remains solvent and psychologically stable long enough will basically inevitably encounter an extraordinary opportunity.
Exactly. So if we zoom out to the big picture, one properly timed macro campaign could essentially define an entire decade of your performance.
One campaign. That's incredible.
Absolutely. Some of the greatest trades in the history of finance came from individuals who waited years for macroeconomic conditions to align properly.
They didn't trade every day.
No, they watched, they analyzed the wick-off phases. Because a brilliant analytical framework is completely useless if emotional impatience destroys your execution.
Right.
But a simple framework combined with extraordinary patience that allows you to compound wealth for decades.
It really is a profound shift in perspective. To realize that professional market operations are heavily disguised.
What do you mean?
Well, they look like an action business from the outside, but at their core, they are purely a waiting business.
Exactly. The market simply does not pay you for your effort. It does not pay you for the hours you spend staring at a monitor, or for your constant activity, or for your high IQ.
It pays you for your timing.
And timing belongs entirely to those who know how to wait.
Which brings us to a broader question for you to mull over as we wrap up today's deep dive. We've just spent all this time dissecting how the most ruthless, complex financial system on Earth actively punishes frantic activity, right?
And only rewards strategic waiting.
Exactly. So look at the constant busyness of our own daily lives. Think about the endless emails, the back-to-back meetings, the frantic need to always be doing something in our careers.
It forces you to ask how much of that motion is actually just noise.
Exactly. Are you genuinely moving forward, or are you just confusing movement with progress?
That's a great point.
Think back to that brilliant farmer we talked about earlier. You know, the one out in the field constantly pulling on the stem of the plant to try and force it to grow.
Right, the one who destroys their own crop.
Yeah. Maybe the real genius is the one who understands the soil, plants the seed, respects the season, and simply lets it grow. Thanks for joining us on this deep dive. We'll see you next time.